Today, we're breaking down JIDE, the JPMorgan International Dynamic ETF, an actively managed fund focused on developed markets outside North America. If you're looking for international exposure beyond the US and Canada, JIDE is designed to offer a more flexible, actively managed alternative to traditional passive EAFE-style ETFs. JIDE invests primarily in large and mid-cap stocks across developed markets such as Japan, Europe, and the United Kingdom. At a high level, its opportunity set overlaps with what you'd find in the MSCI EAFE Index. But unlike passive EAFE ETFs that simply track market cap weightings, JIDE has the ability to dynamically adjust allocations based on changing market conditions. The fund is unconstrained by style or sector, which means it can lean growth or value depending on where the managers see opportunity. It can overweight or underweight certain countries, industries, or individual securities based on its outlook. That flexibility is the core differentiator. Instead of locking investors into static index weights, JIDE aims to respond as global conditions evolve. The portfolio is built around what JPMorgan describes as a core best ideas approach. The investment team combines bottom-up fundamental research with data-driven insights to identify companies with strong fundamentals, improving earnings outlooks, and reasonable valuations. The focus is not just on quality but on positive change, companies where business momentum and fundamentals are trending in the right direction. Environmental, social, and governance factors are also incorporated into the investment process. ESG considerations are not necessarily the sole driver of decisions, but they are evaluated alongside financial metrics as part of the broader research framework. JIDE may also use derivatives, primarily exchange-traded futures, to help manage exposure or adjust allocations efficiently. This adds another layer of flexibility, particularly when shifting country or sector positioning in response to macro developments. From a portfolio construction standpoint, this ETF can serve as a developed international allocation for investors who want something more adaptive than a traditional passive strategy. Developed markets outside North America often move through different economic cycles than the US, influenced by currency fluctuations, central bank policies, energy dynamics, and regional growth trends. A dynamic approach attempts to lean into those shifts rather than simply ride them. However, active management introduces manager risk. Performance depends on the team's ability to correctly assess fundamentals, valuations, and macro shifts. While the flexibility can add value in volatile or changing environments, it can also lead to periods of underperformance if positioning misses the mark. Bottom line, JIDE is built for investors who want developed international exposure with a dynamic, research-driven edge. It is not a passive set-it-and-forget-it EAFE tracker. It's a globally diversified portfolio of large and mid-cap companies selected through active analysis with the ability to adapt as markets change. As always, this discussion is for informational purposes only and is not investment or tax advice. Investors should consider their own objectives, risks, and time horizon before allocating capital. If this breakdown helped, subscribe to the ETF Investor and let me know in the comments. Do you prefer passive international exposure or do you want active management when investing outside the US?